Good morning and welcome to the Prescient Investment Management Multi-Asset webinar for the second quarter of 2023. My name is Natalie, and joining me today I have Rupert, Head of Multi-Asset, and Shriya, Quantitative Analyst. Local and global markets have been volatile over the past quarter, off the back of a challenging macroeconomic and political environment. Today we will look at some of the key events that have shaped the past quarter, as well as discuss our expectations and views going forward. So Rupert, looking back at the last 6 months, what have been the key movers and what can we expect to see for the various asset classes going forward?
Yeah, thanks Natalie, and thanks all for dialing in as always. It's been quite an interesting exercise to look back over the last 6 months. It's something I try and do quite often. So what actually has happened over the last 6 months? And in the prior years, it's been quite an easy thing to identify. This year, not much has really happened over the past 6 months, at least in terms of news and the changes in the world geopolitical environment. We've still got the Russia-Ukrainian situation going on. We've still got a situation within South Africa, political uncertainty, Eskom and the load shedding. Not much has really changed. What has changed over the last 6 months has been a pretty strong rally in global equities, in particular US equities, and a very weak to negative rally, not even a rally, in South African equities. Something that we haven't really noticed, or it hasn't been as publicized as perhaps it should have been. US equities on the broader S&P up more than 10% for the 6 months. The NASDAQ up more than 30% for the 6 months, so a strong rebound off last year's big sell-off. But the Aussie, the top 40, the capped Swix, whichever benchmark you want to pick, they're pretty close to zero year to date. So a big difference between SA equities and global developed market equities. The second thing that I then looked at was, okay, what's the situation between SA equities and emerging market equities? So emerging market equities roughly flat year to date as well. That is in dollars. But if you were to reprice South African equities into dollars, you'd be down around 10% year to date. So South Africa really quite a big laggard year to date in terms of equity market performance and also on currency performance, which means that over the last 6 months, the place to have been as an investor would have been offshore in the dollar, not the rand, adds another 10% on top, and in offshore equities. If you could have picked the NASDAQ, you would have been a real winner above 40%. So where does that take us going forward? That's always the question that we have to ask ourselves. We don't have a crystal ball, but at least we do have a system which can give us some indication of how the market currently sits and the potential for where the movements might go in the coming months. Right, so looking at our asset class overview, how this works at Prescient is that we are neutral when we have no directional view in the shorter term on an asset class. And then we take views between a negative and a positive based on our outlook for that particular asset class, if there is a negative or a positive outlook. So what's changed since last quarter? The interesting thing is we've actually downgraded to more of a bearish scenario. So in particular, what we've seen is US equities having gone to a strong negative. That's been a negative for quite some time. SA equities were on a positive and have downgraded to a neutral, and I'm going to take you through this in a bit more detail. But just going through them overall, SA bonds still offer a very strong value case. Across the rest of the fixed income market, relatively neutral. US sovereign bonds looking negative. And then within what I think is almost always the most important lever, especially if you've got a large amount of offshore exposure, we're currently neutral on the rand. So no big view on the rand, and SA property, DM property, moderately negative. So just digging into one or two of those in a bit more detail. SA equities currently neutral. The picture remains. So we're strong positive on the valuations case. If we dig into that, all that means is that we show very attractive price to earnings ratios, price to book ratios, price to sales ratios, etc. So we know that about South Africa. So what's the headwind? The headwind is twofold. The first is sentiment, which is significantly negative. And Shriya is going to cover that in more detail. But in summary, I mean, I guess it's just because of the outlook on asset class, because of the likes of an Eskom, the political environment, etc. And then financial conditions are not conducive towards a growth type asset class in South Africa. So that puts us on a neutral. US equities, the picture remains the same as it has done for quite some time. The valuations case, in particular after the strong rally, currently negative. So for us, within the positioning of our funds, we have taken off risk in the global equity space, and we are neutral on South African equities.
Thanks, Rupert. So the US has just released their Q2 data, which showed stronger than expected economic growth and tighter than expected labor markets. On the other hand, the SARB has just said that inflation has turned a corner, and this has prompted the markets to reprice the expectations of SARB rate hikes from 4 hikes to only 1 hike. So what are the implications of these recent developments of these two central banks?
Yeah, so again, we like to focus on the top down at Prescient, so important to take the central bank policies into account. It's one of the indicators that we use within our asset class views. So I think let's separate those two out into two separate and distinct banks, and then let's bring them together at the end. So starting with the SARB, their policy is generally to have inflation within the 3 to 6% band. Inflation is sitting just north of that 6% band, right? And they've essentially been forced to hike because the Fed has been hiking. We've seen the rand has weakened significantly because of the Fed hikes originally, and then the SARB caught up. But that's the reality of the game, is if you don't get paid enough to take on emerging market risk, you simply won't take the risk. So the SARB was in a way forced to hike rates. But the SARB did so whilst we had headwinds towards economic growth in South Africa and higher structural unemployment. So for a central bank to have to balance the two of those off, it's quite a tough game. Why I say that is that when we're coming below that 6% upper end of the band, it takes away that impetus on the central bank to hike rates, and you have to start bringing in the other sides of that coin, so heightened unemployment and headwinds towards growth. Okay, so that's the SARB. The Fed has a very different scenario on their hands. They've got inflation which is arguably sticky, core inflation at least, but they've also got an economic environment which is quite strong. So we've had pretty strong, healthy unemployment figures coming out, economic growth coming out on the US numbers, pretty positive. So for a central bank to have that sort of mix, what that means is that they can hike further, and they potentially will hike further. And we had the governor of the Federal Reserve come out and say they are slowing down the hiking cycle, but they are going to hike more. So what happened between the two banks, and why is this potentially impactful on the rand in particular? This is over the last few weeks. What we saw was the SARB repriced for fewer and fewer rate hikes, whereas the Fed repriced for more rate hikes. And I'll show you that in two charts. So starting with the SARB, just taking you through the journey over the last month, what we saw around 1 month ago was the FRA curve pricing in 2 25 basis point hikes, which would take us on the repo rate from a current repo rate of 8.25 up to 8.75, right? What happened over the last month, given the statements from the SARB and given the publications of, or the more recent publications of CPI numbers, very close to that 3 to 6% band, that FRA curve has repriced right down. So now what we're looking at is this FRA curve here, which still shows rate hikes on the cards coming forward. So that's all the way out into the end of 2023, the start of 2024. But that hike is basically now 1 25 basis point hike. So that's the difference that we've seen within the SARB. Now let's focus on the Fed. So comparing the SARB to the Fed, if we step into what the Fed's pricing now, you can see that 1 month ago, which is this turquoise-ish line, the Fed was pricing towards just 1 hike. And now what you see is that the Fed is pricing towards 2 hikes, and to price them also similar to the SARB towards the end of this year. So 2 hikes now priced in from the Fed. And if you look towards the Fed officials and the polling amongst them, this is an interesting one. If you look at the Fed median dot, you can actually see that the latest meeting amongst Fed officials polls for even more hikes than is priced by the market. So that means that you get your Fed funds rate, which is significantly higher than it is now, and your South African JIBAR based to the repo rate, which is not nearly as significantly high than the Fed fund futures on a relative basis. What's interesting for me is the Fed median dots, which show the similar story to what we've been telling you for the last 2 or so years, where in the longer run, it returns all the way down to just above 3%, but they expect rates to stay higher for longer. So a very, very important development within markets over the recent months.
So the SARB has been hiking interest rates aggressively to try and keep inflation at bay. But what about protecting the real value of our currency? Do you think that they're actually achieving that? And with all the volatility that we've seen with the rand, would you say at its current levels that it's actually fairly valued or not?
Yeah, so an eternal question that we always get from clients. It's a very tough question to answer. But our models show that the rand is currently fairly priced. Now things do change, and I say fairly priced, that's not necessarily fairly valued. But an asset class is moved by what we see as 4 groupings of indicators. The first being valuations. I'm sure a lot of you are familiar with these different indicators by now, but valuations, then economics, so the outlook for economic growth, then financial conditions, and lastly sentiment. So whilst the rand can be very, very attractive from a valuations case, there can be poor sentiment towards the country, which there currently is, which means that for someone sitting in an offshore desk trading currency in big volumes, they're going to look at us and they're going to compare us to, say, Mexico, and they're going to say, okay, South Africa's got significant political risk on right now, and the potential for getting that carry trade is just as attractive within the Mexican peso, for example. So right now in South Africa, our view on the rand is neutral. But once indicators like sentiment do change, and they always do change towards the positive, got to be the optimist here, then our view on the rand would change back towards a strong positive.
So let's dig a bit deeper into the rand volatility that we've been experiencing. Specifically, we saw a very big blowout after the news broke around SA's ties to Russia. So Shriya, can you maybe take us through why the rand was so heavily impacted by this event?
Sure, Nat. So the US made allegations that South Africa had basically supplied arms to Russia and that they had loaded weapons onto a Russian ship at the end of December last year. And when the news broke, it sent the rand into a tailspin. So it blew out to around 19 Rand 50 to the dollar. On top of that, the SARB issued a statement regarding the financial implications if secondary sanctions were to be imposed on South Africa, because South Africa has been quite neutral in this Russia-Ukraine situation. And South Africa actually has not condemned the invasion to Ukraine. So, our ties with Russia go back to the apartheid days when they had actually supported the ANC in their struggle against apartheid. And the relationship with Russia is quite complex. Now, unfortunately, the United States doesn't support this. And it poses such negative consequences for trade agreements that we have with them. So right now, we're actually at risk of falling out of the AGOA trade agreement with the US. And that's basically the Africa Grow and Opportunity Act, and it allows sub-Saharan African countries to export to the US. So we're getting this preferential access to the biggest economy in the world. If that were to fall away, then it's going to be bad for our exports, and it's really going to have a detrimental effect on the currency, because then the demand for the rand goes down. So it's not looking great right now. But luckily for us, the rand has come back to below 19. However, it's still quite a risky situation, because if these allegations are proved true, then who knows where the rand could go. And it really has the potential to set us back even further from an economic growth perspective.
So it seems like the behavior in the rand was actually warranted this time.
Totally agree. The rand is a very volatile currency and has the potential to blow out really quickly whenever sensational news hits the headlines. So we know that about the rand, but in this case it was a little more warranted, just because of the economic ramifications that could result if we were to lose the US as a trading partner. And the US is one of our top 5 trading partners from an import and an export perspective.
Thanks, Shreya. So just touching on US inflation, we are starting to see it come down. We have the base effect with the older higher prints rolling out. But core inflation in the US remains sticky. And this is quite concerning, as we know it's one of the key considerations that the Fed uses in their monetary policy decisions. So could you maybe just elaborate on why core inflation has been so sticky, what is driving it, and why are we not seeing a moderation here?
Core inflation differs from headline inflation in that it excludes volatile energy and food prices. So the Fed likes it because it's a more stable measurement of inflation and what inflation is doing. Now, what they want to see is that their monetary policy regime is having the desired effect of bringing core inflation down. But as you said, that hasn't happened. The recent data that's been released has shown that core inflation has increased just under 0.5% every month for the past 3 months. So it does concern the Fed. And what's driving this? Now, inflation is obviously made up of different components, and shelter costs make up quite a big weighting in the CPI basket. And that's actually what's causing inflation to stay at such elevated levels. I think it'll be just easier for me to show you. So I mentioned that shelter makes up the biggest weighting in the CPI basket, and we can see this here in this chart. If I hover over it, we can see that shelter weight was equal to just under 35% in April. Then if we look at CPI itself, or core CPI rather, what has happened is that the Fed has expected the decline in CPI to be much more rapid than it actually has been. If we hover over shelter, we can see that shelter has actually been such a huge contributor to where CPI is right now. If I take away shelter, we can see that the decline in core CPI has come down much quicker, and this has actually been the desired effect that the Fed has wanted to see. So why is shelter causing this upward pressure in inflation? Well, that brings me to my next chart. So what we're showing here are owner's equivalent rent, which is what homeowners are willing to pay to rent out their homes, and rent of primary residence, which is what tenants are actually paying right now. Now, these two indicators are quite important because they're two key drivers of shelter costs. These two indicators track house prices, but they do so with a lagged effect. And this is because when you take out a rental contract, you agree on a price that you're going to pay for the next 12 months, irrespective of what house prices are actually doing. Now, if we were to lead house prices forward by about 12 months, we can see that the indicators track each other pretty well. So this means that we can say with confidence that wherever the housing market is right now, it'll only be reflected in the rental market 1 year later. So when will we see the rental market then cooling? Well, we'd probably only see it 1 year after housing market had peaked, and that's in about April last year. So this means that we can probably expect the rental market to cool in the second half of this year. So that will definitely be something to watch, given that we can see that these two indicators have actually slowed down and they're not rising as rapidly as they were previously.
Thanks, Shreya. It's very interesting and definitely something to keep an eye on. So another thing that's been driving the market environment quite a bit is sentiment. So how has business and consumer sentiment fared in South Africa over the past quarter? And is this sentiment a fair reflection of the current economic climate?
So we have sentiment as part of our 4 main factors in our tactical asset allocation models, and therefore it's quite an important driver because it affects how we view our asset classes. And in this case, South African sentiment will drive our views on our SA assets. Now, over the past quarter, we've seen that consumer and business sentiment have been quite negative, and that's actually reflected in the data. So here we have business sentiment, and what it aims to measure is the average sentiment in the manufacturing sector of South Africa. So it's based on a survey of around 4,000 senior executives from trade, construction, and manufacturing. So we basically want to see what is the average producer thinking and what is the economic outlook. So we see that this indicator was quite good at picking up the recovery post-COVID when the economy opened up again and businesses were able to operate once again. However, more recently, we've seen that there's been this continual decline in sentiment. And Rupert mentioned this a bit earlier, but the high interest rate environment has not made it easier for businesses to borrow. And continual load shedding means that businesses can't operate in certain times of the day, which means that they're probably not taking advantage of all the opportunities that they can. And some businesses have also had to make huge capital outlays in order to, buy solar panels or generators just to keep the lights on. Now, if we look a bit closer, at what has happened over the past quarter, because the data has been updated up till the end of June, we see that there has been, this decline in sentiment. And if we compare this to consumer sentiment, we'll see that this decline is actually more extreme. So here we have consumer sentiment, which is also based on a survey, but it's based on a survey of random households in the country. So it wants to measure what is the average household thinking or feeling about their purchasing power. And what we've seen, again, post-COVID, that people were quite excited to spend all their pent-up savings, but it fluctuated a little bit in between. And now what's happened is that we've also seen this gradual decline in consumer sentiment. We're still in a high inflationary environment, so people probably think that their money can't take them very far. And a lot of people are also getting laid off, because businesses aren't able to operate as efficiently anymore, which obviously means that people can't spend that much. So one view is that the sentiment is overdone and that people in South Africa are too pessimistic because there have been shorter term wins in the past couple months. Inflation is high, but it has been moderating. And there is still load shedding, but we've only been on stages 1 to 3, in the past month. And there has also been an evident increase in the privatization of electricity generation. So we've got to think about that as well. And I think what's been reflected in the data is just people being very frustrated about where the country is going in the longer term. If we look at it on a bit more of a macro view, and if we look at some of the indicators that we have in our models, we see that economic surprises, which is an indicator of economic growth, that has been surprising to the upside. So what that looks at is the difference between what economic prints are and what the market thinks. So if GDP prints above what people expect, it's a positive surprise. And in South Africa, we've seen that this is actually surprising currently to the upside, which is good for growth. On a more global scale, we have an indicator that measures what the demand is for the dollar, a safe haven currency. And we've seen that there's actually been a decline in the demand for the dollar over the past couple months. Now, what that tells us is that there's less of a flight to safety for investors and that there might actually be an increase in investors' risk appetite.
So there are opportunities out there. So Rupert, maybe you can just take us through how the fund is positioned to take advantage of the opportunities, and also how it's avoiding the pitfalls that we've discussed.
Yeah, absolutely. So as you'll know, for us, the first and most important principle is diversification. We do that both across asset class and across geographies. So a theme which has been very, very important over the last year or two, to diversify yourself away from concentration towards the possibility that you have a complete stage 20 blackout or whatever it might be. You want to have less concentration towards South Africa. It's commonsensical. So I'll take you through the positioning of our flagship balanced fund, just to take you through that logic on how we diversify and how we try and avoid those pitfalls in the shorter term. Right, so looking at the balanced fund's asset allocation as it currently lies, what we see is an allocation towards equity-linked assets, so South African equities, emerging market equities, developed market equities. You need that sort of allocation towards a high growth type portfolio. So those will always be anchor allocations. But where we are underweight is that we've got less developed market equities than normal, so roughly 5% less than our target long-term strategic asset allocation. In the other equity asset classes, we are at the long-term strategic asset allocation. And then we've got diversifiers. So what I want to just highlight is how the current extremely high yields in the fixed income space are offering a very attractive opportunity for a CPI plus 6 type mandate, where the combination of inflation coming in and high nominal yields means that you're getting quite a nice payout for taking on risk within South Africa in particular. So yes, SA has its pitfalls and potential headwinds, but you're getting paid out significantly for taking on that risk. That said, we've got the full 45% offshore allocation right now, so we do diversify as much as we can away from that concentrated South African risk, and we park that into hyper-diversified building blocks such as MSCI emerging markets, MSCI developed markets, so roughly 4,000 names in the equity space, and then a basket of developed market bonds and shorter duration developed market income. Just talking towards the rand quickly, we don't take a full 45% exposure towards the dollar-rand exchange rate, and there's a whole story behind that. Simplistically put, that means that you do participate in some of the benefits of the sell-off, so we don't completely remove that dollar-rand exchange rate exposure, but you don't participate in the full thing. And why we don't want to do that is, Shriya basically told us the story, the journey of the rand, blown out from 18 to beyond 1950, and then coming all the way back down to almost 18 again. When it goes from 18 to 1950 and you've got 45% offshore, you look like a hero. But when it comes from 1950 all the way back down to 18, you significantly lag your peers. So we specifically put in currency hedging, and we take a view on the rand. Currently we are neutral on the rand, which means that we have our currency hedge at neutral, and we have our naked dollar exposure sitting at around 25%. So overall, the portfolio positioned relatively close to the long-term structural asset allocation, but there are some tilts in place, namely in emerging markets. So overall, the portfolio positioned very close to a strategic asset allocation, but there are tilts in place, namely the underweight in developed market equities, and overweight into the developed market fixed income space. And then in the SA space, we are taking on a bit more duration within our bond investments.
It's definitely been a very challenging quarter, given all the market volatility and uncertainty. So how did the Prescient Balanced and Defensive funds do, and what should we expect to see for the funds going forward?
Yeah, so I always say it's about the journey. So the important part for us within our Balanced and Defensive funds is that we diversify across asset classes and across geographies, which means that we should have a smoother journey than the peer group, which we do generally have, which meant that when the peer group significantly rallied in May, we did lag them, but when the peer group significantly underperformed in June, we were ahead of them. So it's about the journey for us, and that's what I think is very important, especially for someone in a Reg 28 type environment. So be it a pre or post-retirement type investor, you need a smooth journey. Going forward, we've got a very, and I mentioned this earlier, we've got a very attractive yield profile in the fixed income space. We've also got an attractive yield profile in the offshore fixed income space. There's actually been quite a lot of benefit around all of these pretty painful hikes that we've seen from the Fed. There's now a very attractive buffer or yield buffer within things like developed market treasuries. So as a portfolio as a whole, we see it as a very strong offering with a strong backbone in the fixed income space and a hyper-diversified exposure towards equity markets.
So Rupert, there's been a lot of talk about a global recession in the second half of 2023, and we are in the second half now, so is it still looking like a possibility? And also, is there any light at the end of the tunnel for markets over the next quarter and the rest of the year?
Yeah, so I think let's bring it all together. And you talk about talk. You'll read one blog which says there's going to be a massive recession. You'll read one blog that says there's going to be a massive global market rally. One of the two of them is most likely going to be right. But for us, it's all about systematic investing. So we follow the numbers. Where we see the markets over the next quarter or 2 quarters in the shorter term, Shriya did cover, we are seeing some positive surprises on the economic front, but nothing near the massive growth trend that you would need to grow yourself out of where we currently sit in terms of price to earnings multiples, for example, in the United States. So we still are bearish on US equities. We're happy to take risk off the table in the global equity market. In South Africa, as I said, very attractive yield profile. So if you simply sit and wait, which is often very tough for investors, but if you sit and wait, you're getting extremely attractive yields in the fixed income market. And then even in the equity market, there are opportunities starting to emerge. What we need there is a transformation to get a strong global growth picture, which would then come down into South Africa as well. So there is light at the end of the tunnel, but as I said, for us, it's a systematic approach. So positioning the funds, that's exactly what we do. We follow the model, and that's what the evidence says we should do.
Thank you so much for your time and your insights today, Rupert. Thank you, Shriya. We will now take some questions. Good morning, and thank you so much for joining us today. Thank you for sending through your questions. I will just jump right in there. So our first question we have is, how much does your portfolio change with regards to your tactical asset allocation tilts or views?
I think I'll take that one. So the whole point of our tactical asset allocation model is not for it to stray too far away, or rather the effect is not for it. Sorry, I'm going to start again. So the whole point of our tactical asset allocation model is for it to not stray away too far from our strategic asset allocation. So our strategic asset allocation is supposed to be our portfolio that we would keep for the next. It needs to change a little bit depending on what's going on in the market, but it's not going to change by a lot. So we actually constrain it. We will only tilt very marginally away from our strategic asset allocation. And therefore, what we sell to you is actually what we give you. We're not going to, go 100% into cash if that's what the market wants us to do. We will still stay very close to our SAA, and those tilts are constrained.
Shriya, you touched on US inflation, so I think you can also answer this one. What is your view on SA inflation?
So it's an interesting question because it'll actually come out today at 10 o'clock just now. So keep your eyes peeled. But I think the general expectation is for it to actually come down below the 6% upper target that the SARB has. So the SARB will target 3 to 6% inflation. Right now, Rupert did mention that it's sitting just above 6%. So we do expect that it will come down. And on Thursday, we've actually got the MPC meeting where we'll see whether the SARB decides to hike another 25 bips. There is a 50% chance that will happen, but the SARB is very firm and wants to bring inflation down to the midpoint of that band.
Okay, Rupert, I think this one is good for you. Given that you are bearish on US equities, would you bring this money back onshore or allocate it elsewhere?
Okay, that's a bit of a load. So we could bring it onshore if there are onshore opportunities. Right now, we aren't bringing it back onshore. We've deployed that into offshore fixed income instruments. And there was quite an interesting chart that we put in our latest monthly commentary, which just showed you the yield on offshore fixed income, treasuries, credit, and then equities. And they're basically trading at par at the moment, which means that you're getting a pretty attractive yield profile in offshore fixed income. There's no reason not to get into them. Now, compare this to 3 years ago when people wouldn't touch that with a 10-foot pole because you were just getting essentially negative real yields in offshore fixed income. So there's a new world of fixed income offshore. And that actually ties in with something I have to drop in here because we recorded this a couple of days ago and the Rand's been moving very aggressively since then. So the Rand strengthened back below 18. And it ties in with our hedging profile. So we hedge roughly half of the currency exposure within our funds, which means that we didn't participate half of that offshore exposure in the blowout to 1950, and then the recovery all the way back down below 18. And that's put us right back into the top quartile year to date, as some of the managers with significant offshore exposures but no currency hedging have lagged because of the significant strength in the Rand. Had to chuck that in there, can't resist.
Great, thanks so much, Rupert. I think those are all the questions we have for today. So again, thank you so much for joining us, and we'll see you on Monday at our interest-bearing webinar.
Thanks, everybody.
Thank you.